Well, welcome. Welcome again. This is a fourth video in the financial accounting, and we're going to talk about the closing process, the last part of our accounting cycle. So if I call up the accounting cycle with you one more time, we'll just look at that real quick here. Let's call it up, share my screen with you, and you should see the accounting cycle on the screen here. And we see that at the end of the period, we have our annual, the portion of our accounting cycle. Every year we do our closing entries. We post these closing entries to our ledger to get our post-closing trial balance. So we're going to walk through this process. And why do we do this closing process? Why do we do this? We do this closing process because at the end of the period, we need to close out our temporary accounts. Okay. We have two different types of accounts. We have permanent accounts and we have temporary accounts. We're going to close out those accounts that are temporary. What are the temporary accounts? All those accounts that impact retained earnings are temporary accounts. What are they? Dividends, which we reward our stockholders when we pay them dividends. That money comes out of retained earnings. And also revenue minus expenses, what we're in business to do. We generate revenue, we incur expenses. All those accounts are temporary. They're temporary in that those buckets, think of an account as a bucket. So at the end of the period, that bucket gets emptied and we start new at the end of the year collecting the data, if you will, the transactions for the new period. Okay, so we're going to empty out these buckets into retained earnings at the end of the period. So I'm going to share my screen with you and go back to that spreadsheet that we ended video 3 with. We're going to call that back up, share my screen with you, and go back to the spreadsheet here. So you can see the spreadsheet on my screen, and you'll see this adjusted trial balance that we had last time on our last video. All these accounts here, as I mentioned before, I'm going to highlight them, and let's see, I'll pick it, let's put them in yellow. All these accounts here highlighted in yellow will get zeroed out or closed out at the end of the period. Why? Because all these accounts that are below the retained earnings line impact retained earnings. We're going to roll all this money in this account, in these accounts, into retained earnings by doing the closing process. So at the end of the period, we want our retained earnings balance to be this 231,640. Once we close out all these accounts into retained earnings, our retained earnings account will reflect this 231,640 in this case, because we have our trial balance amount of 215,870. We're going to make an entry to close out our income, our net income, into retained earnings, and also close out our dividends into retained earnings. Again, all these accounts here, our dividends and our revenue minus expenses on net income. All these accounts impact retained earnings. They're going to be zeroed out at the end of the period. Those are our temporary accounts. The permanent accounts stay on the books. The cash, liabilities, equity accounts, all these accounts here, permanent, they stay on the books. And we simply adjust the retained earnings for all the activity that happened during the year that impact retained earnings, everything below the retained earnings line on the trial balance. Okay. So again, permanent accounts do not get closed out, only the temporary accounts. So if you drew a line in your trial balance, anything below retained earnings is going to get closed out to retained earnings. Okay, so let's take a look at that. Get you under the tab. We have our closing. Our closing entries. We're going to do that in a second. So you see here we have our adjusted trial balance in the previous page. It's just copied over from the page we just were on. Okay, so we're going to take all these closing balances and make our closing entries. But we know we're only going to close the accounts. I'll highlight these again. I'll highlight them in yellow. Only these accounts below retained earnings will get closed out. So let's start out with closing out the revenue accounts. Okay, so we'll close out the revenue accounts. So we're going to find service revenue. If it has a credit balance, we have to close it out by debiting it. We'll make a debit to service revenue. Okay. And we want to close out the rent revenue account. So we find the rent revenue account. It has a credit balance, so we want to debit that to wipe it out, zero it out. Okay, so we're debiting revenue accounts. Why? To wipe them out, to zero them out, because they have credit balances. So we're going to do the same for all the expenses. We're going to look at the salaries and wages expense. It has a debit balance. So how do you close it out? With a credit. So we're going to credit that account to wipe that balance out. And then we have all the other, we have utilities expense. Let's find that one. Utilities expense. And we have to credit that for the 62,900. And we have advertising expense. Let's find that account here, advertising expense, and that's 35,200. And then we have, what do we have? Depreciation expense on the building. Let's find that. Depreciation expense on the building, 6,300. Okay, then we have repairs expense. So let's find that account, repairs expense. And that is 31,900. And then we have the next one is insurance expense. Let's find that account. Insurance expense, we're going to credit that for 4,800. We have depreciation expense on equipment. We'll find that account. Depreciation expense, equipment, that's for 17,600. And then we have our supplies expense. Let's find that. Supplies expense, that is $1,730. And the last one to close out is the miscellaneous expense. And that is for 26,700. Okay. What we're missing now is the entry to retain earnings, because we want to move. So we're moving all this money, all these debits and credits, closing them out and moving the difference between our debits and credits, which is our net income, into retained earnings. So we're going to find a retained earnings account. Retained earnings, we're going to credit that for the 40,770. What's the 40,770? That is our net income that we saw earlier. And if you look at the debits total of 545,900, and the credits total 545,900. So our debits equal our credits. It's a beautiful thing when our debits equal our credits. Okay, so then we have the dividends to close out. We have to close out our dividends account. So if the dividends have a debit balance, we have to credit that to get rid of it. And dividends do what to retained earnings? They reduce retained earnings, as we saw previously. So we're going to reduce our retained earnings by debiting retained earnings for the 25,000. And we're going to credit the dividends account, because as a debit balance, we have to close it out by crediting it to get rid of it, 25,000. So there are our two journal entries. One, again, is the first one is to close out our revenue expenses to retain earnings. And the next one is to close out our dividends to retain earnings. Okay, so we see our two entries that we have here. Okay. So let's keep going. So now, once we make these entries, what happens? All these balances get zeroed out. And the difference, so if we take our 215, so if these are all closed out, what's left for our post-closing trial balance are all these accounts here, plus our adjusted retained earnings once we bake in these entries. We'll show you what that is in a sec. So here's our post-closing trial balance. What do we have left? As we do our closing entries, we have our cash balance of 12,500. We have our accounts receivable of 55,400, supplies 2,770, prepaid insurance 1,600, land 150,250, building 250,700, accumulated depreciation credit balance of 106,580, and then equipment has a debit balance of 176. So these are just our balances. We're not doing anything special here other than these are the balances that are left on our books that we didn't wipe out. Okay, accounts payable. We'd like to wipe out the accounts payable, but we can't. We got to pay those bills. All right, unearned rent, and then salaries and wages payable, and then common stock 125. Now, retained earnings. What is our retained earnings balance going to be? Well, it's going to be what we start out with, our beginning retained earnings balance. Remember the stockholders' equity reconciliation from last video. We have the beginning start out balance of $215,870. We're going to add to that net income that we journalized, the $40,770. That adds to our retained earnings. And we're going to subtract our dividends that we just journalized. So our new balance is going to be the $231,640. Okay, $231,640 that we saw on our statement of stockholders' equity reconciliation on the previous video. The $231,640 is shown here on retained earnings. Okay, so again, this is our retained earnings reconciliation right here, and that's at the end of the period. Once we make these journal entries, our retained earnings balance will actually equal what's on our stockholders' equity statement at the end of the period. So this $230,641 will be our beginning balance retained earnings next time. So if you're doing this again next year, this would show $231,640 would be the amount that would show next year when we go to do it. Okay, so that's it for the adjusting process. So once you do the adjusting it, once you do your adjusting entries, you're all set for the new year. So all those balances will begin, your beginning balances for next fiscal year, and you start accumulating more revenues and expenses and go through an accounting cycle all over again. Okay, so it's a lot of fun. Accounting's fun. I hope you enjoyed these videos. I hope they're helping you understand the accounting process. I'll see you next time on our next video. Thanks.